There's been a noticeable surge in conversations around physical gold and silver markets, especially claims that dealers are running out of inventory, sovereign coins are becoming difficult to source, and even suggestions that entire countries are quietly pulling back supply just as demand begins heating up. At first glance, a lot of this sounds dramatic or even exaggerated, like the kind of narrative that circulates in every cycle when metals start gaining attention. But when you step back and analyze it carefully, there is a real story unfolding. It's just far more layered and nuanced than the loudest voices make it seem. To properly understand what's happening, you need to break the situation into three key layers. First is the product layer, which highlights the difference between paper prices, wholesale bars, and the smaller retail products that everyday buyers actually purchase. These categories exist in the same market but behave very differently during times of stress. Second is the behavioral layer, which looks at how people react when uncertainty increases. Historically, when confidence weakens, investors tend to move toward tangible assets rather than abstract financial instruments. Third and most important is the trust layer. This goes beyond inflation or interest rates and touches on confidence in currencies, governments, and financial systems overall. When trust begins to soften, even slightly, demand for physical assets often increases. This doesn't mean the world is running out of silver or gold, but it does mean that the specific forms people prefer, recognizable coins, small bars, trusted products, can become harder to access quickly, even if broader supply still exists somewhere in the system. One of the biggest misunderstandings in this space is the phrase silver is cheap because it's rarely defined properly. Cheap compared to what? The futures price on a trading screen? Large industrial bars traded between institutions? Or small, highly recognizable coins sold to retail buyers? These are not interchangeable, especially during periods of rising demand. The more precise argument isn't simply that silver prices will go up, but that certain forms of physical silver, particularly lower premium options, may currently offer better relative value compared to high premium, heavily branded products. In simple terms, some buyers may be able to acquire more ounces for the same amount of money. By avoiding the products that carry the highest markup, that distinction becomes extremely important over long time horizons. However, it's equally important to stay grounded. Physical metals are not designed for short-term liquidity. They are not a replacement for cash reserves, nor are they suitable for people who may need immediate access to their funds. But for those thinking in multi-year timeframes, the psychology of metals becomes particularly interesting. Unlike stocks, where rising prices often encourage profit-taking, precious metals can behave differently. When prices rise, it doesn't always create sellers, it can actually attract more buyers. Higher prices sometimes signal deeper concerns about the financial system, prompting people to hold tighter rather than sell. This is why metals markets often feel counterintuitive. The motivation isn't always profit. In many cases, it's protection, stability, and a hedge against uncertainty. Another key point that needs to be clarified is the difference between a retail shortage and a global supply crisis. These two ideas are often confused, but they are fundamentally different. A retail shortage means that specific products like coins or small bars are temporarily difficult to find or come with higher premiums. A global shortage, on the other hand, would imply that the metal itself is disappearing, which is not what current evidence suggests. In reality, bottlenecks often occur in the middle of the supply chain. Issues like minting capacity, availability of blanks, staffing, logistics, and distribution can all create friction, even when raw metal supply is sufficient. This has been observed in past stress periods, including the financial crisis and the pandemic, when premiums surged and delivery times increased significantly. The key takeaway is that price on a screen and availability in hand can diverge for a period of time. That divergence is where many opportunities and risks exist. Recent data also supports the idea that demand remains strong. Gold demand has reached record levels, and silver is projected to remain in a structural deficit for multiple consecutive years. Additionally, investment demand for silver is expected to rebound meaningfully, adding further pressure to an already tight balance. This doesn't mean every alarming claim is true, but it does confirm that the underlying market conditions are far from weak. The more accurate conclusion is that the system is active, demand is healthy, and certain products can become constrained much faster than people expect when conditions tighten. When you expand the view to the macro level, the conversation naturally shifts toward inflation, interest rates, and overall confidence in the financial system. This is where many narratives become overly simplistic, often claiming that metals only perform under specific conditions like falling interest rates or economic collapse. In reality, the relationship is much more complex. Gold, for example, has historically performed across a variety of rate environments, including periods of tightening. What matters more is the broader context: real interest rates, inflation expectations, economic uncertainty, and most importantly, trust. Trust acts as the underlying driver that connects all of these variables. If people have full confidence in currencies, government policies, and financial institutions, then traditional assets may remain dominant. But if that confidence becomes less certain, even gradually, then the appeal of tangible assets increases. Importantly, this shift does not require a crisis scenario. Markets don't need to break for metals to perform well. A steady environment with moderate uncertainty, persistent inflation, and ongoing demand is often enough. This leads to a more practical and balanced strategy. Instead of chasing headlines or reacting to extreme claims, investors can focus on steady accumulation, thoughtful product selection, and cost efficiency. Avoiding excessive premiums, prioritizing liquidity, and maintaining a long-term perspective can make a significant difference. Ultimately, the goal is not to predict every market move, but to position intelligently within a system where outcomes are becoming less predictable. While these actions are part of the fund's designed mechanisms, they still signal rising caution among investors. At the same time, ratings agencies have begun to express concern about leverage, funding access, and exposure to weaker borrowers within the sector. These are meaningful warning signs, but they represent stress within a specific segment rather than a direct threat to everyday bank accounts. The transmission of risk typically moves through credit conditions, investor sentiment, and business performance before it reaches the broader public. When viewed through a broader macroeconomic lens, the situation becomes clearer and more balanced. The current environment is characterized by persistent but not runaway inflation, higher interest rates that may remain in place longer than expected, and a financial system that is adapting to these conditions. While some comparisons to past crises are inevitable, the structure of today's risks is different. Exposures in private credit are more concentrated and less intertwined with core banking deposits than the mortgage-backed securities that played a central role in the 2008 financial crisis. Additionally, regulatory frameworks and bank capital positions are stronger than they were in previous cycles. This does not eliminate risk, but it does change how that risk is likely to unfold. For most individuals, the more immediate concerns are not sudden bank failures but gradual economic pressures. These include reduced purchasing power due to inflation, tighter access to credit as lenders become more selective, and shifts in market sentiment that can influence investment performance and job stability. In this context, the most practical approach is not panic but awareness. Understanding where risks are concentrated, how they may evolve, and how they could indirectly affect everyday financial decisions is far more valuable than reacting to exaggerated headlines. Ultimately, the current situation is best described not as an imminent crisis, but as a period of elevated pressure on prices, on borrowers, and on confidence. Recognizing that distinction allows for more informed and rational decision-making in an uncertain environment.